In the early 2000s, low interest rates and relaxed mortgage lending standards created a perfect storm for the housing market. Banks began issuing loans to subprime borrowers, those with poor credit or uncertain incomes. Home ownership soared as financial institutions packaged these risky mortgages into mortgage-backed securities, MBS, and sold them to investors as safe investments. This financial innovation fueled a surge in housing prices, leading to speculative buying and a sense of unstoppable economic growth. As housing prices climbed, so did the number of risky mortgages. Adjustable-rate mortgages and interest-only loans became widespread, allowing people to buy homes they couldn't truly afford. The assumption was that housing prices would continue to rise indefinitely, but by 2006, cracks began to appear. Home prices peaked and started to fall, leaving homeowners with mortgages worth more than their homes. The rapid rise and subsequent decline in home prices set the stage for an unprecedented wave of mortgage defaults. Borrowers could no longer refinance, and banks were left holding billions in worthless mortgage securities. This marked the beginning of a financial crisis that would engulf not just Wall Street, but the entire global economy. By 2007, the U.S. housing market had begun to collapse under its own weight. Subprime borrowers defaulted on their loans en masse, causing the value of MBS to plummet. Investment banks, which had taken on massive risks, found themselves holding billions in toxic assets. Panic spread through the financial markets as the global credit markets froze. Interbank lending stopped almost overnight, and major institutions began to teeter on the brink of bankruptcy. The fall of Bear Stearns in March 2008 was the first major casualty. The Federal Reserve and the Treasury facilitated a sale to J.P. Morgan Chase, but it wasn't enough to stop the bleeding. With each passing month, the crisis grew worse. Lehman Brothers, one of Wall Street's oldest firms, filed for bankruptcy in September 2008, triggering a global financial meltdown. One of the most significant factors in the meltdown was the use of credit default swaps, CDS, which allowed institutions to insure against the failure of these subprime securities. The problem was that these contracts were unregulated, and many firms, like American International Group, AIG, did not hold enough capital to cover their exposure. By early 2008, AIG faced insurmountable losses and was on the verge of collapse. The U.S. government intervened with a $150 billion bailout to stabilize AIG and prevent a global financial catastrophe. This intervention, however, did not prevent the subsequent collapse of other major institutions. Lehman Brothers, founded in 1847, was one of Wall Street's most storied firms. But by September 2008, it was drowning in bad debt. The U.S. government faced a difficult decision: bail out Lehman or let it fail. Treasury Secretary Hank Paulson and Federal Reserve Chairman Ben Bernanke decided that letting Lehman collapse would teach the market a lesson about risk. But the decision had catastrophic consequences. Lehman Brothers declared bankruptcy on September 15, 2008. The Dow Jones Industrial Average plummeted over 500 points that day, and markets around the world followed suit. The collapse of Lehman created a ripple effect, freezing credit markets and causing investors to panic. In the weeks that followed, the financial system teetered on the brink of total collapse. The fall of Lehman Brothers signaled the end of an era on Wall Street. No longer would investment banks operate with the same level of autonomy and risk-taking that had characterized the pre-crisis years. The once dominant Lehman, along with other institutions like Bear Stearns and AIG, had become symbols of financial excess and greed. The aftermath saw the rise of tighter regulations and a shift in power from investment banks to more conservative commercial banks, changing the face of Wall Street forever. As the crisis deepened and major financial institutions began to falter, the U.S. government initiated a controversial but necessary intervention. On October 3, 2008, President George W. Bush signed the Emergency Economic Stabilization Act, establishing the Troubled Asset Relief Program, TARP. With $700 billion authorized initially, TARP aimed to stabilize the economy by purchasing troubled assets and equity from financial institutions, thereby restoring liquidity and confidence in the markets. In the first phase of TARP, $250 billion was allocated to buy equity in 8 of the largest American banks, including Bank of America, Citigroup, and Goldman Sachs. This capital purchase program was designed to provide these banks with the capital they needed to stabilize and continue lending. An additional $80 billion was used to support the auto industry, preventing the collapse of giants like General Motors and Chrysler. The program also included $68 billion for the American International Group, AIG, to prevent its bankruptcy, which would have had catastrophic consequences for global financial markets. Despite these efforts, TARP was met with widespread criticism. Many saw it as a bailout for Wall Street at the expense of ordinary taxpayers. The public was outraged when reports surfaced that banks receiving TARP funds continued to pay large bonuses to executives, leading to the infamous TARP bonuses controversy. In response, Congress imposed new restrictions on executive compensation and bonuses, yet public trust remained low. However, as the economy slowly stabilized, it became clear that TARP had successfully averted a total financial meltdown. By 2010, the Treasury reported that TARP had earned $11 billion in profit for taxpayers, and by the time the program ended, $441.7 billion had been recovered from the initial $426.4 billion invested. The 2008 financial crisis wasn't confined to the United States. It quickly spread across borders, causing a global economic downturn that affected nearly every continent. As the crisis deepened in the U.S., it began to impact Europe's financial system through interbank lending and investment flows. Major European banks like the Royal Bank of Scotland and Deutsche Bank were deeply involved in U.S. mortgage-backed securities. When the value of these securities collapsed, European banks faced immense losses. To prevent a total collapse, European governments intervened with massive bailouts, including a $256 billion European Union recovery plan to restore confidence and stimulate growth. Emerging economies in Asia, which had enjoyed strong growth in the years leading up to the crisis, were also hit hard. While Asian banks were less exposed to toxic assets, the region's economies depended heavily on exports to the US and Europe. As demand for goods plummeted, exports from countries like China, Japan, and South Korea fell sharply. By 2009, China's GDP growth rate had slowed from double digits to just 6.1%, its lowest level in decades. The crisis also led to a significant drop in global trade, with the volume of world trade contracting by nearly 12% in 2009, one of the sharpest declines since World War II. In developing regions like Latin America and Africa, the effects were felt through declining commodity prices. Oil and metal prices dropped significantly, hurting economies like Brazil and Russia, which relied heavily on exporting these commodities. The fallout from the crisis reverberated through the world, leading to widespread economic hardship and political instability. For millions of Americans, the financial crisis was more than just a headline. It was a personal catastrophe that shattered dreams and left lasting scars on families and communities. Between 2007 and 2010, nearly 8.7 million jobs were lost, pushing the U.S. unemployment rate to 10%, its highest level in a quarter century. The crisis disproportionately affected lower-income families, with 39% of households experiencing financial distress, either through unemployment, mortgage arrears, or foreclosure. Entire neighborhoods became ghost towns as homes were abandoned and businesses closed their doors. The downturn in employment had ripple effects on household spending and savings. Consumer spending, which makes up nearly 70% of the U.S. economy, experienced its sharpest decline since World War II. Families drastically cut back on expenditures, with many focusing only on essentials. The decline in spending contributed to a vicious cycle. Businesses suffered, leading to more layoffs and further reductions in spending. In response, many families increased their personal savings rates, but these savings were often used to pay off debt or cover emergency expenses. Government safety nets like the unemployment insurance, UI program, and tax credits, such as the Earned Income Tax Credit, EITC, played crucial roles in mitigating poverty during the crisis. UI benefits were extended up to 99 weeks in states with high unemployment rates, providing a critical lifeline for millions of jobless Americans. Meanwhile, the EITC helped keep nearly 5 million children out of poverty during this period. Despite these supports, recovery for many families was slow and painful as they faced reduced home values, depleted retirement accounts, and lingering job insecurity. The road to recovery after the financial crisis was long and arduous. While the U.S. officially emerged from the Great Recession in mid-2009, it took several more years for the economy to regain its footing. By 2012, consumer spending had finally returned to pre-recession levels, but the scars of the crisis remained visible. Many people who lost their jobs during the recession had to settle for lower-paying positions, and others left the labor force entirely, unable to find new employment. This phenomenon, known as the Great Recession's labor scarring, affected the earning potential of millions and widened the wealth gap. The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in 2010, aimed to prevent a similar crisis in the future by increasing financial regulation and oversight. The law created the Consumer Financial Protection Bureau, CFPB, which was tasked with ensuring that consumers were not exploited by deceptive financial practices. While Dodd-Frank brought some stability to the financial system, its implementation faced significant opposition and debate, with many arguing that it stifled economic growth. The 2008 financial crisis led to profound changes in U.S. financial policy and regulatory frameworks. One of the most significant reforms was the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. The legislation aimed to increase oversight and accountability in the financial system. It established the Financial Stability Oversight Council, FSOC, to identify risks to the financial stability of the United States, and the Consumer Financial Protection Bureau, CFPB, to protect consumers from predatory lending and financial products. The Federal Reserve also took unprecedented actions to stabilize the economy, including implementing quantitative easing, QE programs, which involved buying mortgage-backed securities and treasury bonds to inject liquidity into the financial system. These efforts, along with keeping interest rates at historically low levels, helped foster a slow but steady economic recovery. By 2015, the unemployment rate had fallen to 5%, and the stock market reached new highs, signaling the end of the economic downturn. However, the crisis left a lasting impact on income inequality and public trust in financial institutions. Many argued that the recovery mainly benefited Wall Street, while Main Street continued to struggle. The effects of these policies were felt globally. Countries with more flexible fiscal and monetary policies, like the US and the UK, experienced a quicker recovery, while nations with rigid policies, such as many in the European Union, faced prolonged recessions. In Greece, The crisis led to severe austerity measures, causing widespread protests and political turmoil. Meanwhile, in Asia, countries like China implemented massive infrastructure spending to boost domestic demand, helping the region weather the storm more effectively. The 2008 financial crisis was a stark reminder of the fragility of the global financial system. In its aftermath, governments and regulators worldwide sought to learn from the mistakes that led to the crisis. The too big to fail doctrine, which justified the bailout of large financial institutions, became a central topic of debate. Critics argued that it encouraged reckless behavior, knowing that the government would intervene to prevent systemic collapse. As a result, policies like the Volcker Rule were introduced to limit banks' speculative activities. The crisis also accelerated the rise of alternative financial technologies. Cryptocurrencies like Bitcoin emerged as a response to perceived flaws in traditional banking systems, offering a decentralized and transparent alternative. Similarly, fintech companies began offering new ways to manage personal finances, bypassing traditional financial institutions altogether. While these innovations promised more freedom and efficiency, they also introduced new risks and regulatory challenges. Looking to the future, the global economy remains vulnerable. High levels of public debt, rising income inequality, and the interconnected nature of financial markets mean that a similar crisis could happen again. However, the lessons of 2008 have left policymakers more vigilant and prepared to intervene quickly if necessary. As we move forward, it's crucial to balance innovation with stability and ensure that the financial system serves everyone, not just the wealthy few. Looking forward, the future of finance will be shaped by a delicate balance between regulation, innovation, and global cooperation. Policymakers must stay vigilant to ensure that the mistakes of 2008 are not repeated, while embracing the potential of new technologies to build a more inclusive and resilient financial system. As we enter an era defined by rapid technological change and economic uncertainty, the true test will be whether we have learned from the past and can navigate the complexities of an increasingly interconnected world. If you liked this documentary, don't forget to like and subscribe.